45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Welcome everybody. Wanted to thank you all for joining this afternoon. This is a really great event that we like to host. Basically, our exclusive financing programs that we have here at Marshall Reddick, all with the partners of CMG Financial and Reed Hazard, which I will be introducing shortly. But this has been an incredible path or tool that we've had over the last 18 months, where we've been able to get much lower interest rates than what the market's offering. And it's all through partnerships that we have with our builders, and it's just been a really great path for us. So yeah, I'm excited to go over this in more detail, and yeah, let's do it. Hold on one sec. Reed, if you don't mind, would you mute yourself, please?
Yeah.
Thanks. So everybody, my name is Vince Tomich. I'm an advisor and agent here at Marshall Reddick. I've been with the company now for just over 6 years. I work out of our Newport Beach office, and a lot of what I do is I work with investors in all different, forms, right? So whether it's somebody looking to buy investment property out of state, whether it's someone looking to onboard a property that they already have for management, whether it's someone looking to, borrow or lend in our private lending department, I serve a lot of different, I can service a lot of different avenues, and I have an awesome team to help, facilitate all that. But one of the things I like to just kind of explain to people is, in addition to, of course, being an employee of Marshall Reddick, I am also a client, right? So I like to practice what I preach. I have been in the position of, been fortunate enough to buy property using Marshall Reddick. I've had Marshall Reddick manage that property. I've borrowed capital with Marshall Reddick. I've lent capital with Marshall Reddick. So I've been a practitioner in a lot of the services we offer, and I think it helps be able to explain and share story and share tactics and ideas for people that are seeking a way to generate a better investment or to just explore different options, right? As so many of you have probably been watching the stock market and things that have going on with that volatility. It's places like Marshall Reddick that allows you to have some alternative investments and something to consider. So we're really happy to be able to offer those. And for those of you that are not as familiar with Marshall Reddick, I do like to cover what those services are, right? What is it that Marshall Reddick does, and how can we help you guys? So a little bit more about Marshall Reddick is, I like to describe us as a full service brokerage. So of course, number one is brokerage, right? We help people buy and sell. Whether it's a primary residence or an investment property, we can service that need for you. We have offices in, of course, California, Texas, Tennessee, Florida. And in addition to being able to service you on the brokerage side, our second division is property management. So post-purchase, I would say 99% of the folks that end up buying with us are going to need property management. So we offer that service as well, anywhere from marketing the property, doing the showings, tenant screenings, placing the tenants, collecting the rent, dispersing the rent to you, any maintenance or repair items. We would handle all of that on your behalf, and we handle that in all of the markets that we do our brokerage, right? So it's a way, those two services go very close in tandem. Third is, we are a private money lender, not like the lending that Reed is going to discuss, that's going to talk to us about tonight, which is conventional financing. We do private money lending. So that's going to be more of like your individuals who are going to be doing fix and flips. Again, and this is only for investment property, but if it's a fix and flip, maybe it's a bridge loan scenario. Maybe there is a scenario where you have more than 10 financed properties and you may need some kind of private loan because a conventional loan wouldn't meet the criteria. So we offer services for those folks. Now, in addition to that, we have our investment funds. So the same way that you can invest in property, we give our investors the opportunity to lend their capital. And you can lend your capital via direct loan, meaning we have one borrower and one lender, and we Marshall Reddick would connect you to earn interest payments. Or we also have our mortgage fund. Our mortgage fund has been an awesome vehicle for those seeking passive, consistent income. It's pooled investments from our investors, and that fund then funds hundreds of loans that I just described from the various borrowers, right? So fix and flip loans all across the country. And the benefit of the fund is you're not putting all of your money in one project in one borrower. You're able to spread that risk amongst hundreds of borrowers across the entire country. And it's as passive as an investment as we offer here at Marshall Reddick. So for any of you guys that maybe are tuning into this webinar and wanted to learn more about any one of those specific services, I'd be happy to go into more detail and break that down for you at a future call. Here's a little bit of an outlook of our footprint. So like I mentioned, I'm here in Newport Beach, California, but again, we have offices in all of these highlighted cities here, meaning we have boots on the ground individuals that can assist with brokerage, property management, etc. So this is a little bit more of our national footprint for those of you that are interested. And people oftentimes ask, how did you choose those markets? What makes a good investment market? And these are some of the key criteria that we focus on that we feel support a good investment market. One being job markets. We want to make sure those individuals have a job and income. Low vacancy is important. Economic diversity. Housing affordability, of course, right? Those of you that are here in Southern California know that that's, one of our main obstacles here is the cost of the barrier to entry. Landlord friendly, which is also huge. Good education, and then last but not least, reliable property management, which, fortunately is something we can offer in all of those markets. As we just transition into, before introducing Reed, this is just a quick, snippet of our property management fees and our services. Ultimately, we want to be able to provide an option for those of you folks that are scaling a portfolio and being able to, defer some of the requirements or the needs that a landlord would normally have to deal with, and kind of defer that to professionals. We have maintenance managers, maintenance coordinators, property managers, leasing agents, accountants. We have a whole staff to help support you guys, so you don't have to take on this idea of managing the property on your own. It makes property management much more scalable when you are deferring that to a professional management company. And there's a lot of landlord rules and laws that one would need to be made aware of, and that's our job to stay up on that. Ultimately, our job is to enforce the lease and keep you guys out of court, right? Those are the two most important things for us, and that's something we do at a large scale. We're now just over 3,000 properties across the country, so we have a really good pulse as to what works and what doesn't work. So now next, I am going to be introducing our amazing conventional loan partner, Reed Hazard. Reed has been with Marshall Reddick for almost 20 years now. An amazing resource. He's not only like myself as works closely with Marshall Reddick, but he's an investor. He does this himself day in and day out. I leverage his expertise personally as well as for all of our clients all the time. So really good friend and awesome partner, Reed Hazard. I'll let you take it away.
Awesome. Thank you, Vince. Great to be here with you guys tonight. Thank you for taking time out of your evening to learn about the special financing. Yeah, a little bit about me though. Been doing this since I was 19, just almost 40 years old now. So almost half my life I've been a part of Marshall Reddick. It's super exciting and just so happy to be here. So just like Vince, I also invest myself and use all the services. And I have 4 properties in Texas, and then I have 3 properties, investment properties here in Orange County. all of which are managed from Marshall Reddick as well. So if anybody ever has questions too, just about what it's like to be a client of Marshall Reddick, always reach out. Clients reach out all the time and talk about other things beside lending, and so I'm definitely an open door. Reach out anytime. And just real quick too, our company's licensed in all 50 states, and then I hold about 20 licenses personally too here at my branch in San Clemente. So we're licensed all over the country. We do a ton of business in Texas, Tennessee, and then here in California, obviously through Marshall Reddick. And all the processing and underwriting is done here through my branch, and so it's all done with my team. So for any of you guys that live in California or in other states besides the state that you're buying in, we really try to make it feel like you're doing a loan within your own state. Again, all the processes and systems are all done here at my company. We are a bank. We're not a broker. We're not a direct lender even. We're an actual bank. So we also service our loans, so you make payments to us after closing. We've got an awesome free refinance program where we cover all your lender fees to refinance for any of you guys doing a primary home purchase or having to buy a deal today with normal market rates. Anytime within 5 years after closing, my company will cover the lender fees, cover the cost of the appraisal, and then we cover most of the title fees as well to do a refinance. So lots of benefits for using me and my team and my company CMG. Okay, so information I'm going to be covering tonight, just what is a rate buy down? Just really simple. Current conventional guidelines, what are the max credits that a seller can provide you if you're buying an investment property using conventional financing? For example, you have to meet what's called the minimum investment for the loan program. If it's a duplex investment property purchase, so a 2-unit property, you have to put 25% down is the minimum down payment required in the conventional world. And then if you're non-conventional, you usually have to put even more money down. So conventional always has the best terms. But so for example, you got to put 25% down. That's your minimum investment that is required. The seller can give you 2% of the sales price towards covering some closing costs. But again, what are the max that they can do? How can we utilize that? And then what do rates look like if we're just going to get that max seller credit to buy down the interest rate on a normal loan, not on the special financing? So we're going to kind of cover that to give you a good idea and a good gauge there of what normal scenarios look like when there's no special financing, and then what does it look like when we're actually doing the special financing. So we're going to cover what is a forward commitment. That's how we get the special financing. And then Vince is going to cover some new construction inventory, and then we're going to go over a little bit about buyer paid closing costs so that you understand what types of costs you can expect when you're getting the special financing. So how much do you have to pay as a buyer to get a 3.75% interest rate? Okay, so let's cover rate buy down real quick. How do loan points work? You guys hear discount point out there or buy down? So there's a market rate, and let's say that market rate today for an investment property, just for example, is let's say 7.25%. That market rate is going to have no loan points. That's what you just pay standard closing costs. Okay, so example, $500,000 purchase price with 30% down is going to be a $350,000 loan amount. If you were to pay one loan point, that's equal to paying 1% of your loan amount, which would be $3,500, and that would get you an interest rate below market. On average, every loan discount point gets you about a quarter, in some cases 3/8, an interest rate reduction. When are loan points charged? Again, when you select an interest rate that's below the market rate. Now, some other factors that can affect your interest rate are the purpose of the loan. Are you buying as an investment property? Are you buying as a primary residence? So again, that's obviously going to affect it. The down payment amount, 20% down for a 1-unit property is considered the minimum down payment for investment property. You can actually go 15% down, but again, 20% is considered a minimum. And so that's the highest priced loan out there for investment property. You go 25% down on a 1-unit property, your pricing is going to be a little better. 30% down is the sweet spot. 40% down is the best pricing. But then your return on investment starts to go down a bit because you're putting so much cash into the deal. So it can make sense to do 40% down if you're doing a 1031 exchange, or you just really want higher cash flow, or maybe you're getting closer to, to retirement age and you want to make sure you have a really good leverage ratio with a lot better cash flow. We have buyers that go 70% down. But by and large, 30% down is going to be kind of the best combination of cash flow and then return on investment, because you're not putting so much money into the deal to get that cash flow. So again, those are kind of how the different tiers can work and how your loan pricing can be affected. And then what is the market interest rate today for a primary residence? That's just a good gauge for everybody. You're at about a 6.875%. Last Monday, you were at a 6.25% in the morning, and then by Wednesday, you were at 7.25% because we had a massive bond sell-off. Different countries have been selling off our debt because they hold a lot of our debt to push up our yield, and part of that's kind of, I think, the negotiation tactic on their end going on between, these whole Trump tariffs and these 60 other countries that we're in the process of negotiating tariffs with. So a lot of volatility right now in the bond market and in the interest rate market. For today, we're going to use 6.875 as a good gauge for the market rate. Okay, how much can a seller contribute towards my rate buy down? Even on the special financing options, it's the same thing. It's always going to be capped at 2% of the sales price. So simple example, if you buy a $500,000 property investment, you bought a primary, you can get more seller credit. We're talking about investment right now. $500,000 property, 500,000 times 2% is 10,000. So okay, on that size deal, we can ask for a max of 2% sales price credit. And that money can be used to buy down the interest rate. It can be used towards closing costs, and you could take a normal rate and look to refinance in the future if you're not as cash flow sensitive. You could do a combination of both, put some towards buy down and some towards normal closing costs. But that's your max that you can use. And if you were to use that $10,000 today towards buying down your rate on an investment property transaction, you would be about a 6.25, 6 3/8. So this is an actual screenshot of what pricing looks like when we run it through our engine on our end. For example, on the far left-hand side, right over here, we have the rates. We have the monthly payment for principal and interest. We have the closing costs, okay? This is the dollar format. This is the points. So, for example, 6.375 would be 2.889% of your loan amount you would pay in buy down costs, which in a dollar format would be $10,112. As you can see right here, the 6% coupon is tied 6 to 6.5 rates. So when you go into the lower sixes, for example, not a very big difference here. So, the 10,000, give or take a little bit of money out of pocket for you as well. You get right on down here to about a 6% rate, 5.99 under this scenario, not, using that 2% sales price credit. When you go down into the rates into the 5s and then the low 5s and then anywhere in the 4s, the cost to obtain the rate goes up dramatically because there is no demand for mortgage-backed securities or mortgage bonds anywhere down in those lower 5s or high 4s. You see how this works, how all banks work. Let me give you an example. If I'm a hedge fund and I have $100 billion of money that I have under management, okay, I'm going to take that $100 billion and I have to buy stocks and I have to buy bonds. Okay, I'm going to buy maybe 50% of that in the S&P 500, 500 biggest companies in the world, or in the nation. It's pretty safe overall. It averages about a 10% return over time. So I'm going to buy 50% in S&P 500 index. Then maybe I'm going to buy 20% in mortgage-backed securities. And what are mortgage-backed securities? When I do your loan for $400,000, and then the next client's loan for $500,000, and their client's loan for $300,000, and they're conventional loans, those loans are all packaged together into a bundle, and they're sold in the secondary market to institutional investors. They have the ability, those loans, what makes them safer is those loans essentially could be sold to Fannie Mae and Freddie Mac, which is nationalized by the government. They're government entities, right? Because those loans are being underwritten off of conventional guidelines. But Fannie Mae and Freddie Mac do not buy all of those loans, right? They're just underwritten with the ability to be sold there off buyers' credit scores and off their income and off their assets and verifying all that. It makes it a safer bond, essentially, right? So again, I might buy 20% of mortgage-backed securities because they're going to pay 6%, or they're going to pay 5.5% or 7%, depending on how many of those loans were funded within that specific coupon. Okay, so without getting too deep into it, that's how mortgages are packaged together and sold, and that's who's buying them. A lot of times institutions are then buying these types of loans. So I might buy 20 billion worth of mortgage-backed securities, and then I might buy 30 billion in treasuries. Whenever the United States needs a loan to pay for our debt or pay for, the bills, we issue debt into the market. If you Google 2-year treasury note or 5-year or 7-year or 10-year, this is the government essentially issuing debt into the market, and then investors can then buy that debt. And so again, that's how a portfolio is generally put together. And when you talk about demand, the problem is rates below, call it 6%, there's not enough of those loans being done and packaged and bundled together where an institution can even buy them. An institution is not looking to buy $5 million or $50 million even worth of loans. They have a lot more capital that they have to use up. They got to buy $1 billion worth or $2 billion worth or 500 million worth. And so again, because there's so little demand for those types of interest rates, because there's not enough of them being done, you see the interest rates that are closer to market rates, rates in the 6s, where there's a lot of those loans being done, right? Some with buy down, some with the best credit scores, right? They might get a little better rate than the next person that doesn't have as good of a credit score. So there's a lot more of those loans being done. And so for that purpose and that reason, the pricing is better. The cost to obtain those rates is not as high. And so again, that's why you'll see to about a 5.99 rate, it's still palatable. And if we're not going to use special financing, we can go out there and request 2% of sales price credit, and we can get that approved from a seller, and we can get you a really, really great deal. But again, anything in the low 5s, the market rates over time, what will happen is over the next 2 to 3 years, as inflation gets closer to 2% and then hits 2% eventually, when it does, and we get past a lot of this tariff stuff, you will see market rates. It's very likely that they're going to come back down. And as the market rate becomes 5.5% again, and not 6, 8, 7, 5, then now you're going to see buy down rates in the low 5s on investment properties looking very similar to what a low 6 looks like right now. And those are going to be palatable, and those are going to be doable rates. But that's how mortgage rates move. It's how they move daily. And I'm going to go to the next slide. I think I explained that well, but I don't want to go too much deeper on that. Okay, conventional guidelines. Again, max seller contribution, 2% of sales price credit. And then I just gave you guys the example there. If you were to use that towards buy down, you can get down, again, with a little bit of money out of pocket to about a 5.99. That's kind of your cutoff. So what is a forward commitment? Okay, we work with a lot of builders, and they go, Reed, I'm going to commit to giving you $10 million of loans in the next 6 months. And if they do that, that is a separate transaction than the transaction between us, the bank, and you, the consumer. They can buy the money from our company. They can buy a rate sheet. Here's an example of what it looks like. This is $1 million trade size. Just as an institutional investor would maybe buy $100 million of these types of loans, we have our own securities. It's called CMG securities. We're able to write any amount of trade size that we like, and then we can fund those loans within the trade and then allocate those to a big bond pool we have, and then we sell that bond pool on the secondary market. Now, we do sell very large amounts, 100 million at a time or so. But again, what's cool about my company is they've allowed me to do these smaller trades and latch on to a bigger trade essentially, and allow a builder to buy money from us. Okay, usually they'll open about $5 million at a time. This is an example of just $1 million trade that was opened. Okay, and as you guys can see, 4.25% interest rate's going to cost 8.5 loan points. Well, going back here for just a minute, what is a forward commitment? They are committing that they're going to give us these loans in a certain amount of time. Let's say a 6-month lock. I now have that, call it $5 million available. Now, when you come and you apply with me, right, to buy a new construction duplex, for example, that the builder is offering this type of financing, depending on what the builder is able to pay, if they're like, look, we can pay $30,000 a loan, or we can pay $40,000, or whatever that dollar amount is, okay, I then can take that, their money essentially, and I can slot it on your loan. And now your 4.25% interest rate, okay, they're going to cover the back end cost of this. Now you get your 4.25% interest rate, and the only loan points that you pay are called your loan level pricing adjustments for you buying it as an investment property based on your down payment, based on your credit score, okay? Those might be 1.5% or 2.5% of the loan amount. So you might have 10,000 in points, but you're getting a 4.25% interest rate. It's a forever loan. You don't have to touch it for 10 years, right? And also, it's even negotiable. You could try to negotiate the seller to cover those loan points that you're required to pay. And you could get a loan probably for even no points. We've been able to get that negotiated with the builders that we work with. Sometimes no, maybe you're trying to, maybe the demand is super, super high that month and they're able to give you some, maybe a point or a point and a half. But by and large, we've been able to get a lot of these deals negotiated where the builder's covering this back end cost of the money and they're giving you a seller credit on the front so that you're getting these types of rates with actually not paying any loan discount points. Okay, so the first question that I get is, well, like, where is this money going? Like, is this built into the purchase price? And I will tell you right now, what's so cool about this, we have to order the appraisal through a third-party management company. They select the appraiser. There's nobody influencing the value of this property. They go out there and they appraise the property on multiple other communities that aren't even doing this financing, right? They're looking at what is selling in the market, and you get your appraised value based on comparable sales. And these properties have definitely been appraising. We've also noticed that last year, the rents, I believe, were either at the bottom or within a couple percent of the bottom, or we maybe have already even bottomed. The rents are going to start coming up again. They're going to start rising over time. But last year, the rents, for example, in Texas came down, and we were originally, the builders were doing these at about a 5.25 on average because the cost is very, very high. And, they ended up having to buy them down a lot more than that to get properties to cash flow well. They also did a price drop. And when they did that, we've noticed that the prices and the interest rates being offered are a very good mixture, and the demand is there and the numbers make sense. And I don't feel like you're overpaying at all. So much that I even bought one myself. I added a property last year in December, a new construction duplex out in Buda, because I was able to get a 4.25 interest rate. They did a $20K price drop, and I felt really good about it. And for example, the area is so good, I had 2 tenants in place within 30 days in January, which is the worst month to rent, it really anywhere, but especially in areas where it's really cold. It's very, very cold in Texas in January. So very, very strong demand in that location. But the numbers worked for me. I was able to get good positive cash flow. The purchase price makes sense. The cost to build is not going down. And I just felt very, very good about it. And so I think the minute that the builders don't have to do this anymore, when market rates do their thing and they start edging down over time, this is the first thing that they're going to stop doing, because they didn't build these properties with this margin built in. They're digging into their margin right now to do this, and they've done price drops because they have inventory that they want to sell and they want to move on to the next project. And then as they build their next projects, they're probably going to have to start building something in to be able to still make money, because frankly, their margins have been pinched. They've been way, way pinched, but they still make money. Even pinching their margins like they have, builders still make money. What's interesting is if you're a resale seller though right now in this market and you're trying to compete against the builder has the margin that they can dig in, and to sell their last 50 properties in their community, they can do this type of financing so we can get good cash flow. And unfortunately, if you're a resale seller, you're not going to be able to compete with the builder right now. I think that that's going to change over time as market rates come down and as we see absorption happen. But again, in some of these markets where they've been a bit overbuilt coming out of COVID, these are the types of opportunities that we're seeing right now, and they're not going to be here forever. And so again, I even personally took advantage this last December and I bought one. So what are the buyer paid points cost for obtaining the special financing? It's based on your credit score and based on your down payment and based on your reason for buying. And so to confirm exactly what the cost is, we have you go to my website, click on the Apply Now tab. We'll get your different documents from you so we can process the pre-approval, and then we'll send you a closing cost worksheet based on the exact breakdown. On average, to give you an example, if you're putting 30% down and you have a 780 plus mid credit score, we each have 3 scores, right? We always go off the middle one, the mean score between the two, or between the 3. And if there's 2 of you on the loan, we always go off of whoever has the lower mid credit score between each borrower. Okay, we always have to default to that. That's how conventional lending works everywhere. But again, based off all of that, we will then have your loan points, and the points are about 1.7% of the loan amount with that 30% down, excellent credit, buying as an investment property. So just to do simple math on that, if it's a $500,000 loan amount, you'd have about $8,300 of points you would have. And then the Marshall Reddick realtors out of state, and Vince and the different real estate advisors, they're all very well trained to try and negotiate as much as they can from the seller. And again, I mean, we've been pretty successful at getting a seller credit also to cover those points on top of covering that back end cost of money that they have to pay. So you can walk into a deal with a fairly priced property, new construction in a great location. Most of these are all A-class locations, some are B, but most are A. And you can walk into positive cash flow with 25 to 30% down because you have that special financing rate. Okay, Vince is going to go over some of the featured properties, and then I'm going to cover a few slides a little bit later. I'll give it back to you, Vince.
Thanks, Reed. That's awesome. That was really helpful. A lot of awesome detail there. One thing I wanted to, touch on that Reed was, kind of mentioning a couple of things here. But first, we'll talk about why new construction. So why is new construction kind of the typical path that's been working the best for us for the past, 18 months or so? Well, of course, the forward commitment, that is probably above and beyond the biggest reason. It's the rate buy downs and the incentives, which is here, right? So let's talk about a couple other items though. Less maintenance, right? As you can imagine, a new home, everything's brand new. There's going to be less to maintain. 2 is there is very good tenant demand for new construction. You have to think about it from a sense of a tenant, right? Like anybody, tenants like newer, nicer, bigger, just like anyone else somebody who's going to buy a primary would. So a new build is oftentimes more sought after than maybe a pre-owned or an older home. You're going to have more variety. There's all types of different floor plans and models and locations and all kinds of different things that you have control of when looking in the new construction space as well. So that's very helpful. And then, like I mentioned, builders are willing to offer the most incentives, the most crucial being that rate buy down. There's also all kinds of other incentives, whether it's closing cost credits or maybe credits towards free property management or price reductions. You have to think about it from the eyes of sellers, right? So builders and sellers being the same people. What seller has the most pain point? Is it the seller who's an individual who owns one property, who they don't really need to sell, and they're going to put a kind of a high price on the market and wait for their one buyer? Or is it the builder who has 20 lots, that has construction loans on those 20 lots, that's accumulating interest every month, that need, in order to move on to the next project, they need to sell one? So there's a lot of incentives from builders, and it's not just local builders, it's national builders, it's all builders. So when builders are offering this, it's one of those times where you have to take a look and say, wow, this makes sense. Because for those of you that might have been looking to purchase new construction, in 2020 and 2021, it was a very different story, right? Where there was no inventory. Builders were the only ones that had inventory, and there was a whole different dynamic, right? We would do anything that the builder asked for because that's what the market demanded. So another thing is the warranties that come with new construction. Those are fantastic. Like I said, we've had a great relationship with all of our builders in high quality, but in the event that there's any kind of deficiencies, we have amazing builder warranties that are able to cover. Now, Reed kind of touched on, here's an example of one of the duplexes in South Austin that we have been raving about. This is a City of Buda. This is in the same community that Reed mentioned that he purchased. This is from one of our most trusted builders in Texas. We've been doing business with them for many, many years, and it's been just an amazing product that they've been able to build for us. Now, for a few years, as Reed mentioned, there was that limit, that 2% closing cost credit that we would ask for the builder. Oftentimes, we would take those funds and pay some of your closing costs or buy down the interest rate, and that worked for a while. But as Reed mentioned, there was a time, there's now come a time where that amount of money, 2% of the loan amount, or 2%, I'm sorry, of the purchase price, is not moving the needle enough. Hence, we've gotten into this forward commitment, right? And as Reed touched on in more detail, it's the builder basically buying down the interest rate on your behalf, okay? So we were faced with an option, which is the builder saying, how can we give more to you? And it's through this method of the forward commitment. They're not actually giving it to you, the investor. They are giving it to CMG and Reed, in which Reed has now secured money at this rate. So anyone can buy this property with this rate, assuming that there is enough that the builder has offered for that, for this, tranche of money. So moral of the story is we've been able to get rates down to 3.75, right? So this is probably our lowest interest rate available in all new construction. So you'll see here, we have a starting list price of $619,500. We make an assumption of a down payment of 30%. And then we have our closing costs there, which and that includes your points, right? So that's your natural closing costs that you would pay on any transaction, as well as the points involved, which is about 1.5 to 1.7% of the loan amount. And when you factor all that in, you're all in for about $206,000 on this particular transaction. You have your interest rate of 3.75. We have our taxes, our insurance, our management fee. We have an HOA, and then utility and landscaping are covered by the tenants. So when that's all done, we see our fixed expenses here is $33.77, and we have our gross rents there at the top of $37.90, which leaves you a monthly cash flow of $412, which is awesome. This has been a great consistent number, especially this is day one. A lot of people sometimes get caught up on looking at the cash flow day one, and the reality is as time goes on, what typically happens to rents in the long term? Rents usually go up. For that reason alone, you're going to start to notice improvements in cash flow. In some situations down the road, maybe there are refinance opportunities. I would argue in this case at 3.75, you're probably going to want to hold on to this loan for as long as you can, just given where this rate is and where the market rates are. But this monthly income or this cash flow can definitely grow over time. And then as you look below, we have our estimated maintenance and vacancy, as well as our leasing fees that we average over every 18 months. What you'll find here is that anybody who owns property, you're going to go through maintenance, you're going to go through vacancy at some point. So these are just estimates that we assume based on our certain property class, this being an A-class property. But with that, there is a negative of 180, and what that is basically assuming is that with the maintenance, with the vacancy, with the leasing fee every 18 months, that you're going to have that year one. Like I said, with rental increases over time, that is not going to be a factor for very long. And I think it's pretty rare to be able to buy new construction that day one does cash flow after fixed expenses, and cash flows quite well. So you'll also see here a return on investment of 21.87%. So what this is telling you is, assuming you hold this property for 15 years and you accumulate this appreciation for 15 years, and this also does not factor in rental increases, the appreciation alone is going to be able to help yield you about 21% on a 15-year annual average. So this is a pretty amazing opportunity for those looking multifamily and for those of looking new construction. Here's a quick little snippet about, just kind of the Austin market. You'll notice this in all of our properties. We're going to have this this little heat chart here on the bottom left corner. This kind of shows the property classes all the way from luxury to D-class properties. And where this typically will be mainly focused is as the median home price. So the property price, you'll notice on the website will have, like it says, designation ABC. This is an A-class property based on where the price lands. So A-class properties, we make assumptions for maintenance and vacancy that are 8%. B-class, we say 10%, and C-class, we say 13%. We don't do any D-class properties, and every once in a while we'll also do luxury. So luxury would fall more in the line of A-class for those maintenance and vacancy assumptions. I like to point out this this appreciation trend. So we have data from the National Association of Realtors. So year over year, from 1999 all the way to 2023. So this is right about the time of the year where we're able to recognize all of 2024 data. But you'll see, year over year, Austin has been just amazing. And yes, in 2023, we took a step back, and I would look at that as a huge positive. For my 6 years of being here, Austin has always been a bit too hot of a market to touch, right? It's just, there's always been ultra competitive, very difficult to make any form of cash flow, even after fixed expenses. And now the tables have turned where there's a bit more inventory. There's a bit more opportunity to cash flow. The market's a little softer. This is the time where I think buyers have an advantage, as opposed to, 3 or 4 years ago, where it was white hot and you would have to submit 100,000 over ask, right? So, I think this has been a great opportunity for those of you that are unfamiliar with Austin. Austin has been a huge tech hub over the past few years. Some of the major companies there are Dell, Apple, Amazon, Google, IBM, Meta, Tesla, Samsung. They have Oracle Semiconductor there. So lots and lots of great companies moving that way. In addition to that, there's a great there's great university, great education there. You also have huge festivals, right? So South by Southwest is huge. Austin city limits. And as of recently, there's been a push for 3 large movie studios going on in Austin. So that's been another new industry that's starting to evolve there as well. So lots and lots going on in Austin, not to mention it's about, give or take 30 to 45 minutes from San Antonio, which is the second largest city in all of Texas. So to be, in South Austin, basically kind of on the tail end of Austin and wedged next to San Antonio, you're really putting yourself in a great location between 2 major metropolitan areas.
Vince, if I could just mention one other thing about Austin right now, if it's still TBD because I want to see the follow through, but I mean, Apple's talking about they've committed $500 billion in infrastructure spending, right? As part of what's going on with Trump trying to bring more money back into the United States to build chips and all these other things. I mean, if this all comes together like it's being talked about, Austin's going to completely, just go gangbusters over the next 20 years. Do some research on it, do lots of research, but it's all over the news. It's all over online, Google. Just look at all the money that is going to be going into Austin. That's why I personally bought one in South Austin. I have another property in Austin in a place called Bee Cave. It's just a really, really nice location that I bought in 2018. You know, don't overinvest anywhere, but if you don't own anything in Austin, it's a great buying opportunity right now because prices have come down so much, whether you buy resale or you buy new construction. And again, so much money is going to be going into Austin, Texas over the next, 36 months, call it. If all that follows through, even if it doesn't follow through, Austin's going to do just fine. All these companies are already there. But again, the spending that's being committed right now is unbelievable. So let's see how that all turns out. Okay. Thanks, Vince.
Thanks, Reed. So next we have a property here in Punta Gorda, Florida. So this is about 35-40 minutes from our office in Cape Coral. Texas has been our longest lasting relationship with this forward commitment financing, and this is now kind of transferred into some of our other builder partners. So I wanted to bring up a new construction development in Florida. So this one is very interesting because this property is already completed. This property is actually both tenant occupied. So there's already tenants in both of these units, which is amazing. And the nice thing is there's going to be a free year of property management here. So this one is, zero management for first year. So we're looking at first year numbers here, but it does show based on the purchase price, $634,900, 30% down payment, $4,100 in rent. And now in this case, the interest rate is 4.75. So for those of you that ask, like, well, why is this one 4.75? And to Reed's point earlier, it's all dependent on what the builder is willing to offer. So what's a really cool concept, and we've done a lot of math on this, I'm just using round numbers. Let's say the builder was to say, hey, I'm willing to contribute $50,000 to incentivize a buyer. We have a couple options. Do we take $50,000 off the list price and have you buy this with a normal, 7% market rate? Or do we take that $50,000 and move a 7% interest rate down to 4.75 or down to 3.75? And the answer is the numbers are significantly better when we attack that builder incentive money towards the interest rate and not towards the purchase price. I've noticed that by adjusting the purchase price, we move cash flow, $10, $20, where when we adjust the interest rate from the 7s to the 4s, or even in some cases, like in Texas, the 3s, we're getting hundreds of dollars swings in cash flow. So that's kind of the motivation and the logic of what we're doing here. So you'll see kind of quickly this breakdown: $4,100 in rent, our principal and interest payment at $475, taxes, insurance, no management fee for year 1. That management fee will resume year 2 and will be 8%. Then you don't have an HOA or utilities. There is a slight landscaping fee there. But then you're left with a monthly income of $401.68, and that is, again, your monthly cash flow after all fixed expenses. So then you'll back out your variable expenses, and then again, you'll see your return on investment here, assuming a hold time of 15 years. So these have been great. Here's a kind of a similar outlay for Fort Myers and Cape Coral. So those markets being very close. But one thing that's a bit different from Florida than it was in Texas is that appreciation trend, and that path is a bit more volatile here, right? There's higher highs and lower lows. Ultimately, many years with double-digit increases. There's also, you'll see there through the 2006 to 2009 some pretty steep declines. But nonetheless, for the past 10 plus years, we've been on quite a run in Florida. This market in particular, I think, has had a lot more inventory over the last 12 months. So if there's a time to kind of attack a deal, this would be the time. Very low unemployment rate, third fastest. Forbes lists this as the third fastest area for job growth in the nation. As you know, there is a lot of hospitality there and tourism, but there's also medical, lots of medical and construction going on there as well. So I think another nice metric that I like to point out is the Cape Coral growth rate of 4.31% and Fort Myers of 3.45%, which is always great to see population growth and to see that year over year. So a little bit more information about our Cape Coral Fort Myers area. And then lastly is we have an office in Clarksville, Tennessee. So Clarksville, awesome market, about, let's call it 40 to 50 minutes from Nashville. So we have a great new construction community that we have, like I said, a builder who is offering incentives, and we are able to leverage Reed's resources for special financing. Now in this scenario, the interest rate is also 4.75. Now, as Reed pointed out, this is subject to change, right? So essentially, in this case, if you read the description, the seller's offering $15,000 towards buyer's concession. Now this basically $15,000 has been applied towards the interest rate. So this is not in combination of both. We have used that $15,000 to get that 4.75% rate. But as Reed mentioned,
Vince, if I can explain it too. So as I showed you guys before, we're locking in commitments all the time so that we always have money available. But the market rates do change. They change every single day. And so, for example, if the market rates fly up like they did recently after being really low, we actually locked in a bunch of money when they were really good. I locked in, I think, another $3 million that we're using just for the Tennessee properties and for Florida and for like off properties that we do where the builders are maybe only selling a few. When I think we locked in close to $10 million with our biggest builder out in Texas when pricing was just really good. And that way the cost of the builder is not as high because I locked it at a really good time, and we can keep the rates at 3.75 and 4.25. If we run out of that money, which we have before, and the market rates are higher when I have to go to lock more money in, well, the builder can pay whatever, $15,000 towards the deal. Well, that $15,000 on the new rate sheet from the new commitment that we locked in, that might get us down to a 5.25 interest rate. So we were actually just selling 5.25 on this because it's all that we had available up until about 30 days ago. And then we started locking in new money as pricing started to improve. And now, right now, with what we have locked in, we can offer a 4.75. But again, from time to time, if the market rates are higher, then you're going to see these rates fluctuate, and they might be 5.25. So anyways, sorry to jump in, Vince. I just wanted to explain that.
No, that's really helpful. And that's the point I was trying to make, right? Which is like these rates can change based off of market and kind of how much money has been secured beforehand. So it's important to, when you see an opportunity that's making sense now, to be able to jump on that, because like we have been explaining, these can change over time, and we have seen them change. So like I said, those that are interested and motivated and want to learn more, we're happy to do a more deeper dive into particular properties or markets to learn more about it. Again, here's our final snippet about Clarksville, Tennessee, and kind of how this market has been performing. You'll notice in specifically in Tennessee and Texas, the appreciation trend, which is this from 1999 to 2023. And the path has been a very steady, consistent growth, right? Year over year over year, the very small declines, towards the financial crisis we had in 08 and 09, but very, very steady and strong all the way through. So that's always great to see. Clarksville is home to Fort Campbell, which is the second largest military base in the country. We have, we're very close to Nashville, like I said, about 30 to 45 minutes, I would say. And then all types of quality of life, rankings that Clarksville falls into, right? So number 9 most diverse places to live in Tennessee. Number 4 where millennials are gonna buy in 2024. And then 3 hottest zip codes on Open Door, and number 3 most affordable, fastest growing cities to consider. So lots of interesting things going on in Clarksville. and there's definitely, we've noticed a lot more employers moving to Clarksville, and it's those kind of blue collar, awesome, jobs that are great to have tenants in, right? So, we're seeking those single family homes that are going to have tenants for long periods of times, and that ends up making the most sense for our investors, right? Is those long-term, for those that are seeking that long-term buy and hold strategy. I'm going to turn it back over to Reed just to kind of cover as to why CMG has been so great and such a great partner. And then we'll go ahead and get this closed out for you guys.
Great, and I want to be mindful of our time, so I'm not going to spend a lot of time on this slide. I think I already covered a lot about our company, so we're going to go on ahead and skip this slide for right now, and then anyone that wants to speak after the event or over the next couple of days, just reach out to us. But we're a phenomenal company. We'll take amazing care of you.
Awesome. And this is Reed's contact. Anybody, for those of you that I'm happy to make this connection, but for those of you that are in front of your screen or want to have a separate conversation with Reed, feel free, don't hesitate to reach out. Like I said, in addition to being an amazing loan partner, he knows a ton about our company, what we do as an investor, and as also somebody who's just been around for 20 plus years. So here's his contact for any of you guys that are looking for that. Knowing that you guys are on a webinar tonight in seeking education, we wanted to be able to share. We have these data packets that are associated with any of our properties in any of our markets, where you can get more up-to-date data as to the demographics of a particular market, jobs, population, tourism, all the things that may be of interest to a potential investor. So we have all of these. They're free on our website, and I can show you guys where to get them. MarshallReddick.com. And you can click on any of the properties and you'll scroll in the middle of the page where you'll be able to find these data packets. You'll also see our Reddick rating ebook. So this is a more of a detailed explanation on that colorful chart where it shows from luxury to D class and explains more of a deeper concept of how we've derived at these particular property classes and what that means to you as an investor. Again, this is free information. You can find this at marshallreddick.com/ebook. And then for more educational videos, articles, and guides, marshallreddick.com/learn. You guys can watch recordings like tonight from the past and different topics, right? Whether it's a particular market specialty or how to buy investment property, 1031 exchanges, tax webinars, all kinds of information. And I'd be happy to guide you in the right direction. I will be doing some follow-up calls this week, right? Just to kind of touch base, learn a little bit about what brought you to this presentation. If there's anything we missed or anything we can add to shed some clarity. So kind of cover the who, what, when, where, and why. But yeah, these calls can be as short or as long as you want. This is my contact information. So any of you guys that are interested in contacting me direct, there's my cell phone number and my email. And yeah, you can always also find us at marshallreddick.com/consultation. So wanted to thank you guys for spending time this evening. It's always amazing to be able to connect with our folks on webinars, and I can't thank Reed enough for this awesome opportunity to leverage forward commitments and special financing through CMG. He's made a huge difference in so many investors' lives recently. So I want to thank him and thank you for your time tonight, Reed.
Thank you, Vince, and thank you guys for spending time with us tonight. Hope you all have a great evening, and we'll talk to you soon.
Thanks.